Before there was FTX, before Theranos, there was Enron. It was once the seventh largest company in America, hailed as the future of energy, with over 20,000 employees and a stock price that seemed unstoppable. Then, almost overnight, it collapsed in the most infamous corporate fraud in U.S. history. Welcome to Cash and Chaos. This is the story of Enron, the energy empire built on lies. Enron began as a natural gas pipeline company. Under CEO Jeffrey Skilling and Chairman Ken Lay, it transformed into an energy innovator, claiming to pioneer a new model, trading energy like stocks. The market loved the story. Enron's stocks soared. Fortune named it America's most innovative company 6 years in a row. But behind the scenes, things weren't just murky, they were criminal. Enron used a shady accounting method called mark-to-market. Instead of reporting actual earnings, they booked projected future profits immediately. If they signed a 10-year deal expected to make $100 million, they counted all $100 million up front, whether or not they ever earned it. This let Enron create the illusion of perpetual growth. Former Enron CFO Andrew Fastow built complex shell companies, like Raptors and LJM, to hide the company's mounting debt and bad deals. Enron looked profitable, but it was bleeding cash. Employees were pressured to hit impossible targets. Critics were silenced or pushed out. And despite all the red flags, Wall Street analysts kept rating Enron stock as a strong buy. The company was burning from the inside. In August 2001, CEO Jeff Skilling abruptly resigned. A few weeks later, Enron executive Sharon Watkins sent a memo warning of an implosion waiting to happen. She later testified to Congress. The company was a house of cards. The spark came from a Fortune article titled "Is Enron Overpriced?" written by Bethany McLean. It questioned how Enron made its money and why its finances were so opaque. That article triggered SEC investigations. The more investigators dug, the worse it got. Enron's financials unraveled. The stock crashed from over $90 to under $1. Investors lost billions. Employees lost pensions. Thousands were laid off. On December 2, 2001, Enron filed for bankruptcy, the largest in U.S. history at the time. In a congressional hearing, Senator Byron Dorgan said, "Enron is the story of a powerful few who cooked the books, duped investors, and crushed lives." Arthur Andersen, Enron's accounting firm and one of the Big Five, was found guilty of obstruction of justice for shredding documents related to the scandal. The firm collapsed, taking 85,000 jobs with it. Jeff Skilling was sentenced to 24 years in prison. Ken Lay was convicted, but died before sentencing. Fastow served time after pleading guilty to conspiracy and fraud. Enron's legacy? The Sarbanes-Oxley Act, passed in 2002. It reformed financial reporting and imposed stricter oversight on public companies. But laws can't fix hubris. Enron's fall wasn't just about accounting tricks. It was about unchecked greed, toxic culture, and executives who sold hope and hype while insiders cashed out. As Jeff Skilling once said, "We are the good guys. We are on the side of angels." He was wrong. This was Cash and Chaos.